Preparing for a Cisco FP&A interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A contribute to a company like Cisco? FP&A connects Cisco's strategy with measurable financial outcomes. I would support planning, rolling forecasts, variance analysis, and management reporting while explaining the operational drivers behind revenue, margins, operating expenses, cash flow, and headcount. In a technology company, I would also distinguish product, subscription, and services economics. My value would be turning accurate data into clear recommendations, helping leaders decide where to invest, where to control costs, and how performance affects the broader outlook. While answering, focus on budgeting, forecasting, performance analysis, decision support, business partnering, and translating operational drivers such as product demand, subscriptions, services, headcount, and channel activity into financial outcomes. Question 2. How would you build an annual budget for a Cisco business unit? I would begin with the prior year run rate, current forecast, strategic priorities, and corporate targets. Then I would build a driver-based plan covering bookings, revenue recognition, gross margin, headcount, compensation, vendor spend, and discretionary investment. I would validate assumptions with sales, operations, and functional leaders, reconcile bottom-up requests to top-down guidance, and document risks. Finally, I would present scenarios and obtain approval before loading the budget into the reporting system. Make sure to cover the planning calendar, historical baseline, driver-based assumptions, collaboration with business owners, top-down targets, bottom-up submissions, review cycles, scenario analysis, and final governance over approved budgets. Question 3. What is the difference between budgeting, forecasting, and strategic planning? A budget is an approved financial commitment, usually covering the next fiscal year and providing a control baseline. A forecast is a current estimate of expected results, updated as facts and assumptions change. Strategic planning looks further ahead and tests how investments, markets, capabilities, and competitive choices shape future performance. At Cisco, I would use the budget to manage accountability, the forecast to guide near-term decisions, and strategy to connect resources with long-term growth. In your answer, talk about purpose, timing, flexibility, level of detail, and decision use. Distinguish the fixed annual budget from updated outlooks and longer-term strategic choices. Question 4. Walk me through how you would prepare a monthly forecast. I would start by loading the latest actuals and comparing them with the prior forecast and budget. Next, I would update revenue using pipeline, bookings, backlog, renewal activity, shipment timing, and recognized revenue, then refresh margin, headcount, and expense assumptions. I would challenge unusual movements with business partners, quantify risks and opportunities, and reconcile the total forecast to corporate guidance. I would finish with a concise summary of changes, causes, and actions. Be sure to mention actuals, latest operational data, business owner inputs, key assumptions, run rate analysis, seasonality, risks and opportunities, reconciliation to prior forecast, and communication of changes. Question 5. How would you analyze a revenue variance at Cisco? I would build a bridge from forecast to actual revenue, separating volume, price, product mix, customer or geographic mix, foreign exchange, and timing. For Cisco, I would also examine hardware shipments, subscription conversions, renewals, services activity, backlog, and channel sell-through where relevant. I would validate the story against operational data and speak with sales or supply chain partners before concluding. The final explanation should distinguish a one-time timing issue from a structural change. Focus on separating price, volume, mix, timing, foreign exchange, cancellations, contract changes, and accounting effects. Explain how you would validate the bridge with sales and operations data. Question 6. How do you explain a gross margin variance to senior stakeholders? I would quantify the variance and separate recurring drivers from one-time items. The analysis would consider product and services mix, pricing and discounting, component or manufacturing costs, freight, utilization, reserves, foreign exchange, and revenue timing. I would compare actual results with the assumed standard and identify which drivers management can influence. Rather than saying margin was simply lower, I would explain the bridge, estimate the future impact, and recommend actions such as pricing discipline or cost control. Make sure to cover revenue mix, product costs, services utilization, pricing, discounts, freight, reserves, foreign exchange, purchase accounting or other one-time items, and a clear action-oriented conclusion. Question 7. What is driver-based forecasting, and why is it useful? Driver-based forecasting links financial results to measurable business activity instead of relying only on percentage changes. For example, revenue may reflect units, average selling price, renewals, contract value, and recognition timing, while expenses may reflect headcount, salary rates, cloud usage, or vendor contracts. This approach makes assumptions transparent, improves scenario analysis, and helps explain changes. At Cisco, it would allow leaders to understand not just what the forecast is, but which operational levers create it. In your answer, discuss operational metrics linked directly to financial results, improved transparency, easier sensitivity analysis, reduced arbitrary assumptions, and examples relevant to technology revenue and expenses. Question 8. How would you forecast headcount and compensation expense? I would begin with opening headcount by function, location, and cost center. Then I would model approved hires by expected start date, planned attrition, vacancies, promotions, merit increases, bonuses, commissions, and benefits. Timing matters because a role starting in October has a different annual impact from one starting in January. I would reconcile the model with HR records and recruiting plans, challenge unsupported requests, and present both the base forecast and hiring-related sensitivities. Be sure to mention opening headcount, approved requisitions, hiring timing, attrition, salary increases, bonuses, commissions, geography, vacancies, and reconciliation with HR and business leaders. Question 9. How would you investigate an unexpected operating expense increase? I would first isolate the increase by account, cost center, geography, and month, then compare it with budget, forecast, and prior year trends. I would review transaction detail, purchase orders, accruals, invoices, headcount, and foreign exchange effects to determine whether the movement is timing-related, recurring, or one-time. I would discuss the finding with the expense owner, correct classification or accrual errors, update the forecast, and communicate the financial impact together with a practical mitigation plan. Focus on comparing actuals with budget and prior periods, transaction-level detail, accruals, purchase orders, headcount, timing, foreign exchange, one-time items, and confirming corrective actions with owners. Question 10. What KPIs would you monitor in Cisco FP&A? I would monitor revenue, bookings, backlog, recurring or subscription revenue, renewal rates, gross margin, operating expenses, headcount, productivity, and operating cash flow. The right mix depends on the business model and decision being made. For example, revenue may show current performance, while renewal rates and backlog provide forward visibility. I would also track forecast accuracy and variance closure, because reliable planning is itself a key FP&A outcome. KPIs should prompt action, not merely populate dashboards. Mention financial and operational indicators including revenue, bookings, recurring revenue, renewal rates, gross margin, operating expenses, headcount, productivity, cash flow, and forecast accuracy, linking each to decisions. Question 11. How would you analyze a forecast that is below target? I would quantify the gap to target and break it into revenue, margin, expense, and timing components. Then I would test the assumptions using pipeline, bookings, backlog, renewal data, staffing plans, and current spending. I would separate temporary timing issues from structural risks and distinguish controllable actions from external factors. My recommendation might include reprioritizing investment, tightening discretionary spend, improving conversion, or revising expectations. I would present a credible recovery case alongside downside and base scenarios. In your answer, discuss decomposing the gap, validating assumptions, distinguishing controllable and uncontrollable drivers, assessing timing versus structural issues, and recommending specific recovery or resource decisions. Question 12. Describe a useful scenario or sensitivity analysis for Cisco. A useful scenario could test the impact of slower enterprise demand, delayed product shipments, or faster subscription adoption. I would define a base case, then vary volume, timing, pricing, mix, margin, and hiring assumptions while measuring effects on revenue, operating income, cash flow, and capacity. I would document the logic rather than create arbitrary percentages, identify early warning indicators, and recommend actions for each case. The analysis should support a decision, such as investment pacing or cost flexibility. Make sure to cover a clear decision, key variables, base, upside, downside cases, quantified effects on revenue and profitability, probability or risk assessment, and how management would use the results. Question 13. How do revenue recognition and deferred revenue affect FP&A analysis? Revenue recognition determines when contracted value appears in the income statement, while billings and cash may occur earlier. A subscription or support contract can therefore create deferred revenue that converts to recognized revenue over time. I would distinguish bookings, billings, revenue, and cash when analyzing performance, especially for recurring offerings and services. A revenue shortfall might reflect timing rather than weak demand, so I would review contract terms, backlog, deferred balances, and future recognition schedules before drawing conclusions. Be sure to distinguish bookings, billings, recognized revenue, deferred revenue, and cash. Explain contract timing, subscriptions, services, and why operational performance cannot be inferred from revenue alone. Question 14. How would you evaluate a new investment or cost initiative? I would start by defining the strategic objective and measurable outcome. Then I would estimate incremental revenue, gross profit, operating costs, implementation investment, working capital effects, and timing. I would compare the base case with alternatives, test sensitivities, and identify execution risks and accountable owners. Depending on the decision, I might use payback, ROI, contribution margin, or discounted cash flow. After approval, I would track actual benefits against the business case and explain any variance. Focus on strategic rationale, incremental revenue or savings, investment requirements, timing, risks, return metrics, scenario analysis, ownership, and post-investment tracking against the original business case. Question 15. Tell me about a time you improved a financial reporting process. In one reporting process, analysts manually consolidated files from several teams, creating delays and inconsistent definitions. I mapped the workflow, standardized the chart of accounts and KPI definitions, and built validation checks before consolidating the data. I also created a simple ownership calendar so submissions arrived on time. The process reduced manual rework, improved review time, and increased confidence in the output. I would bring the same mindset to a global FP&A CoE, standardize what should be common, while preserving useful business detail. In your answer, use a clear situation action result structure, include the original pain point, root cause, process or automation change, stakeholder adoption, control improvement, and measurable time or quality benefit. Question 16. How do you ensure data quality in a global FP&A environment? I would establish a single source of truth, documented KPI definitions, clear data ownership, and consistent dimensions for entity, geography, product, function, and account. I would reconcile source system totals to the general ledger, use validation checks for missing or unusual values, and investigate exceptions before reporting. Version control and an audit trail are important when multiple regions contribute. I would also communicate definitions clearly, because data quality depends as much on governance and behavior as on technology. Mention common definitions, source system reconciliation, dimensional consistency, validation rules, ownership, documentation, version control, exception reporting, and review controls across regions and functions. Question 17. How would you manage conflicting priorities from global stakeholders? I would clarify each request's purpose, deadline, decision impact, and dependencies before committing. Then I would prioritize work aligned with close, forecast, executive decisions, and material business risks. I would communicate trade-offs early, offer a minimum viable output when appropriate, and confirm revised timelines in writing. If priorities remained incompatible, I would escalate with facts rather than opinions. The objective is to be responsive without sacrificing accuracy, control, or consistency across global stakeholders. Be sure to cover clarifying urgency and impact, aligning to corporate priorities, transparent trade-offs, stakeholder communication, escalation when necessary, and maintaining quality under competing deadlines. Question 18. What makes an effective management report or dashboard? An effective dashboard answers what happened, why it happened, what may happen next, and what decision is required. I would limit metrics to those linked to strategy, show actuals against forecast and target, highlight trends and material exceptions, and provide drill-down detail when needed. Definitions, refresh timing, and ownership should be visible. For Cisco stakeholders, I would tailor views by audience, giving executives concise actions while enabling analysts to investigate product, region, channel, or cost center drivers. Focus on decision relevance, concise design, consistent definitions, trend and variance context, drill-down capability, visual hierarchy, action ownership, data freshness, and avoiding excessive metrics or presentation complexity. Question 19. How do you balance accuracy and speed during a forecast cycle? I balance speed and accuracy by focusing effort on material drivers and decision-critical information. I would use standardized templates, automated checks, prior period baselines, and a documented assumptions log to reduce avoidable work. Early reviews can catch major errors before the final deadline, while materiality thresholds prevent excessive time on insignificant items. If information remains incomplete, I would provide a transparent range, explain the limitation, and update the forecast when better data arrives rather than presenting false precision. In your answer, discuss materiality, standardized templates, early checks, automation, clear deadlines, assumptions logs, review thresholds, and communicating limitations rather than delaying decisions for immaterial perfection. Question 20. Why are you interested in a global FP&A CoE finance analyst role at Cisco? I am interested because Cisco combines complex technology economics with a genuinely global operating environment. A global FP&A CoE would let me apply financial analysis while improving planning consistency, reporting quality, and decision support across teams. I am especially motivated by translating operational data into clear insights on revenue, recurring offerings, margins, and investment choices. My strengths are structured problem-solving, attention to detail, and collaborative communication, which would help me deliver reliable analysis at scale. Make sure to connect Cisco's technology and transformation agenda with your analytical skills, process discipline, collaboration, interest in scalable planning, and motivation to support global decision-making through reliable insights. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.